Did you know that if you had invested just $1,000 in Amazon when it went public in 1997, your stake would now be worth a staggering $1.2 million today? That's the power of the stock market, and that's the reason why you should pay more attention to this video. Stick around until the end to discover a secret strategy that can help you achieve similar mind-blowing results. So today I'll take you to Stock Market for Dummies, a beginner's guide to successful investing. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. The stock market can be an intimidating place for beginners, with an overwhelming amount of information and terminology to navigate. It's easy to feel lost and unsure of where to start. Many newcomers are held back by a fear of losing money, especially in volatile markets. After all, the thought of watching your hard-earned savings disappear can be terrifying. Another common challenge is the confusion surrounding the process of actually buying and selling stocks. How do you open a brokerage account? What's the difference between a market order and a limit order? And how do you research and analyze potential investments? Even for those who manage to overcome these initial hurdles, staying disciplined and avoiding emotional decision-making can be a struggle. It's easy to get caught up in the hype surrounding hot stocks or to panic and sell during market downturns. But don't worry, because in this video, we'll address all of these challenges and more. We'll demystify the stock market, providing you with a solid foundation of knowledge and practical strategies to help you navigate the investing world with confidence. Let's start by breaking down the basics. What exactly are stocks? Think of them as tiny pieces of ownership in a company. When you buy a stock, you become a part owner of that business, entitled to a slice of its profits and growth. It's like buying a share in your friend's lemonade stand. Except instead of getting a cut of the quarters they make, you get a portion of a multi-billion-dollar corporation's earnings. Pretty sweet deal, right? Now, the stock market is essentially a massive playground where these ownership slices get traded back and forth between investors. It's like a giant swap meet, but instead of trading baseball cards or vintage lamps, we're swapping stakes in companies like Apple, Google, and McDonald's. At the heart of this playground are stock exchanges. Think of them as cool kids' hangout spots. The two biggest and baddest in the US are the New York Stock Exchange, or the NYSE, and NASDAQ. These are the places where the real action happens, where buyers and sellers come together to haggle over stock prices. But how do you actually make money in the stock market? Well, there are a few different strategies to consider. First, we have buy and hold. The buy and hold strategy epitomizes the essence of long-term investing. It's a philosophy that encourages investors to purchase stocks in companies they believe will experience sustained growth over time and then hold on to those investments, allowing them to mature and compound. This strategy is often likened to planting a money tree. The longer you allow it to grow, the more abundant the fruits of your labor become. Legendary investor Warren Buffett is a vocal proponent of this approach, having built his fortune by adhering to this principle. Next is trading. Trading represents a more dynamic and hands-on approach to investing, suited for those who are willing to actively manage their portfolios and navigate the turbulent waters of the stock market. Unlike the patient demeanor of buy and hold investors, traders engage in frequent buying and selling of stocks with the aim of profiting from short-term price fluctuations. It's akin to participating in a bustling stock market swap meet, where traders constantly seek out lucrative opportunities and swift transactions. However, trading comes with its fair share of risk, as the market's unpredictable nature can lead to substantial gains or losses. Successful trading demands a combination of skill, discipline, and a strong tolerance for the inherent volatility of the market. And finally, we have dividend. Dividends offer investors a direct share of the company's profits, distributed periodically as cash payments. This income stream is akin to receiving a regular allowance from the companies, in which one holds ownership stakes of. Dividend-paying stocks are particularly attractive to investors seeking passive income, such as retirees or those desiring a consistent cash flow to supplement their earnings. Embracing dividend investing can provide a reliable source of income while still allowing for the potential growth of the underlying investments over time. Now, before you dive headfirst into the stock market, there are a few key concepts you'll want to understand. First is diversification. This is crucial for mitigating risk in your portfolio. By spreading your investments across different companies, industries, and asset classes such as stocks, bonds, real estate, etc., you ensure that if one area underperforms, the others can help offset those losses. Imagine having all of your money in a single stock. If that company tanks, you're wiped out. But with a diversified portfolio, you're protected from any single point of failure. Next is market capitalization. Understanding a company's market cap gives you a sense of its size and growth potential. Large cap stocks, think Apple and Amazon, tend to be more established and stable, while small caps have greater growth upside but also higher risk. Mid caps fall somewhere in between. Generally, a well-diversified portfolio will have exposure to a mix of large, mid, and small caps. There's also the PE ratio. This metric helps you evaluate whether a stock is overvalued or undervalued relative to its earnings. A high PE could mean investors are paying a premium for anticipated future growth, while a low PE might signal that the stock is a bargain. However, the right PE can vary by industry, so it's important to compare apples to apples. Next is technical analysis. Technicians believe that past trading activity and price patterns can be used to predict future movements. Things like trend lines, support resistant levels, and momentum indicators are their tools of the trade. It's like looking for clues in the stock's price footprints to figure out where it might go next. And finally, fundamental analysis. In contrast to technical analysis, fundamentalists focus on a company's actual business performance, such as their revenue, profits, cash flow, competitive position, and etc. They believe that ultimately a stock's value is derived from the health and prospects of the underlying company. Popular fundamental metrics include the PE ratio, debt levels, profit margins, and growth rates. While technical and fundamental analysis take different paths, many successful investors blend aspects of both when evaluating potential investments. The key is finding an approach that resonates with your personal investing style and risk tolerance. That's one of the beauties of the stock market. There's always something for everyone, whether you're a conservative investor looking for steady growth or a risk taker chasing the next big thing. There are strategies and opportunities to suit your style. And if there's one takeaway you leave with from this video, let it be this. Diversification and the power of compounding are your secret weapons for stock market success. Diversification is like having a superhero team instead of just one superhero. By spreading your investments across different companies, industries, and asset classes, you can minimize your overall risk. That way, if one investment takes a hit, the others can help cushion the blow. But the real magic happens when you combine diversification with the incredible power of compounding returns over time. Compounding is like having a money-making machine that keeps churning out more and more dollars for you. The longer you stay invested, the harder that machine works, turning your initial investment to a mind-bogglingly larger sum. Just look at the numbers. If you had invested $10,000 in the S&P 500 index 30 years ago and left it untouched, thanks to the power of compounding, that initial investment would now be worth over $200,000. That's the kind of wealth building potential we're talking about here. Well, we've practically covered the fundamentals of stock market investing, from understanding key concepts to exploring different strategies. Remember, success in the market requires patience, continuous learning, and a well-diversified long-term approach. Let me know in the comments what's your biggest challenge or fear when it comes to investing in the stock market. I'll do my best to address your concerns in future videos. And if you found this guide helpful, be sure to give it a thumbs up and share it with your friends. And that's basically Stock Market for Dummies, a beginner's guide to successful investing. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.